So today's Technically Speaking post on the website now, realinvestmentadvice.com, covers an email that I got speaking about the markets, right? Because we've been writing over the last couple of weeks that the market's breaking out to new highs. We've allocated our portfolios on the long side. Basically, I wrote in this last weekend's newsletter that, well, all we have to do right now is kind of just sit back and watch because, well, with portfolios fully allocated, I don't really need to worry about what's making the market go up because, well, we're already invested, right? So telling me why the market's going to go up really doesn't help me much as a portfolio manager or as an individual investor. What I need to be aware of are the things that might actually go wrong that would make me want to get my money out of the markets, right? So, I mean, isn't our job ultimately to, buy low and sell high? And of course, what nobody ever tells us is, well, when we actually need to sell. So, this is part of the portfolio management process, something we're going to cover later on in the show today. We're going to go through our 12 investment rules. But in the short term, I did want to talk about just for a minute is some of the issues surrounding the level of complacency that's currently occurring in the markets. Again, there doesn't seem to be a real concern about risk, no matter kind of what goes on in the markets. Fed's raising interest rates are over 3%. We've got tariffs going on, another $200 billion there. Really, no matter where you look, individual investors are simply saying, it is what it is. Markets are going up. I don't need to worry about it. But actually, we do. And so while it may sound like just because we're agreeing that the market's going up and that we want to be invested, which is currently true right now in particular, it doesn't mean that we're complacent to the notion that, well, things are just going to go up forever and we're in a new bull market and you don't have to worry about any risk whatsoever. That's the thing we'll go through. So one thing here is, let's look at the markets here real quick. What you'll notice is that every time that we've broken out of these markets, we've come back down and kind of retested that breakout level. These have been good opportunities, as we've been talking about in our newsletter, to add exposure to portfolios and increase allocations. And again, here we are once again retesting that level of support, holding on to that very closely. And if this market continues to consolidate here, like I said a few minutes ago, we're all kind of working off that overbought condition. We're potentially going to continue this trend potentially into the end of the year. Now, again, there's not a lot of upside here. Risk reward is negligible at best, and we're probably talking about maybe a run to 3,000 by the end of this year. That would be optimistic. That would put us about a 10, 11% gain in the books for the year, about average for historical medians. So when we take a look at this, the trend is still positive. We want to participate. But when we start looking at this, there's a lot of things that are very similar to what we saw in the last market peak. Now, in the newsletter and in the report today, Technically Speaking, I quoted some stuff that I wrote back in 2007. Back in 2007, December the 1st to be exact, I said, hey, right now the markets are positive. We need to remain long the markets, but you'll want to start taking some precautionary measures because next year, things are likely to get much more difficult. That's the same message we're talking about right now. Back in 2007, the markets were trending very positively. Nothing to really be concerned about. A similar correction like we saw at January, February of this year. Markets rallied back from that. Of course, you know what happened in 2008. But you see the same thing that in the markets today. Same type of bullish trend in the markets. Had a correction. Markets recovered from that. So a lot of similarities between now and 2007. 2007, lots of bullish sentiment. Goldilocks scenario, nothing to worry about in the economy. Don't worry about subprime mortgages. Those are contained, but ultimately they weren't. Same thing with the preferences of stocks versus bonds. Back in 2007, the stock-bond ratio was near an all-time peak, very, very extended. Again, preference of stocks over bonds. Why do you want to own those silly bonds? You want to be in the stock market. That's where the money's being made. You see exactly the same thing today. Once again, you've got stocks versus bonds extremely extended all over again. Why? Same preference today, right now. Why do you want to be in bonds? Interest rates are going up. You only want to be invested in stocks. Of course, that turned out not to be such good advice in the next 12 months. Currently, today, right now, according to a recent poll from Gallup, economic concern is not even a concern. It's actually concerns about the economy are now ringing in at 12. That is the lowest level since 2007, the last time that we were the most unconcerned about weakness in the economy. Basically, Americans simply not concerned about the economy. It's growing. Everything is great. But the problem here is, again, when we start taking a look at how investors are extremely confident of the markets and of the economy. Right now, the number of investors that are extremely confident about higher returns in the markets over the next 12 months is at the highest level that we've been since 1999, even going all the way back to 1996, of course, even 2007, higher than we were prior to the peak of the markets in 2007. Investors are extremely confident that with the economy strong and interest rates going up, nothing's going to derail this market, and markets are only going to be higher 12 months from now. Also, take a look at consumer confidence. Of course, numbers came out today. Consumer confidence just hit another new high. That's great. Everybody's super confident about the economy and the markets and what's going on economically. So, not surprisingly, we see a similar place, consumer confidence, back to the level that we haven't seen since 1999 and 2000, back as high as 1969 prior to the 1974 crash. The important point about extremely high consumer confidence is that's what you see at the end of a market cycle, an end of an economic cycle, not the beginning of one. People aren't super exuberant about the economy and the markets and just the consumption in general, because at the bottom of cycles, when you're beginning a new cycle, that's where everybody is the most scared, right? And so people have to come back. Now, what happens, we're always the most exuberant right at the end of the cycle. Now, this doesn't mean the market's going to crash tomorrow or next month or next week. I'm not saying that at all. The point here is that these peaks in consumer confidence have typically been associated with peaks in the financial markets. Again, the simple reason is that by the time you get to these levels, you're at the end of a cycle. So, what's going on right now that could change this dynamic, right? Everybody's super confident, everybody's super happy. So what could change that? See, that's what we have to have. In order for this market to begin to correct, we're going to have a change in that overall sentiment. So what are those conditions? We have growing divergences between the U.S. and the rest of the world. The rest of the world is slowing down. We don't seem to be affected at this point. We have peak autos, peak housing. We're seeing housing prices starting to come down. Auto sales beginning to weaken, GDP likely also at a peak, political instability. We've got trade wars and tariffs going on around the world. Of course, you've got the midterm elections that are coming up. Failure of fiscal policy. This is one of those issues. It's not, tax cuts and tax reform was great, but it's failed to actually trickle down through the economy. Real wages aren't growing. Real incomes aren't growing. In fact, if you just take a look at our recent report about the 80% of Americans that can't afford retirement, goes just to prove that point. An important pivot towards a restraint in global monetary policy. Central banks globally are beginning to cut liquidity, not increase it. Of course, we've got this lack of coordination between central governments around the world, and short-term note yields are now higher than the 10-year Treasury. So we are starting to find a place that there is an alternative to investing, and that's buying short-term bonds. Higher yield than both the 10-year Treasury and even potentially, in some cases, the dividend yield on stocks. Record levels of public and private debt, and of course $3 trillion of junk bonds that are now at risk. We've got over $1 trillion worth of debt maturities coming up in just the next year. Each one of these are in and of themselves a problem or a signal about a weakening economic environment. All of these combined are a much different issue. When we come back, though, I want to talk about the 12 things about investing that you need to know. So make sure and subscribe to our YouTube channel. Get all of our podcasts and updates and videos. We'll come back in just a second and talk about the 12 things you need to know about investing your money better. The 12 rules of investment coming up next on The Lance Roberts Show. Don't go away.
Catch The Lance Roberts Show anytime, day or night, online at lancerobertshow.com.